SpaceX confidentially filing for an IPO.
SpaceX is currently preparing for what's expected to be the largest IPO in history.
Every financial outlet on Earth is running the same headline: SpaceX, $2.1 trillion IPO, the largest public offering in the history of human capital markets, and almost every single one of them is wrong about the number. On April 1, 2026, SpaceX confidentially filed a draft Form S-1 registration statement with the Securities and Exchange Commission. That filing is the beginning of the largest IPO ever attempted, but the number inside it is not $2.1 trillion. It targets a valuation of $1.75 trillion, with a capital raise between $50 and $75 billion. The $2.1 trillion figure in the headlines is a pre-roadshow banker pitch Morgan Stanley and Goldman Sachs are floating to sovereign wealth funds behind closed doors. Not a prospectus number, not an offering price, not codified in the public record yet. So today we separate what has actually happened from what banks want you to believe, because whether the final number lands at $1.75 trillion or higher, the shockwave has already hit. This is episode 69. Drop a rocket emoji in the comments if you want the truth, not the hype, and let us get into it. What actually happened? The path to this IPO happened in 4 discrete steps over 6 months. Each step doubled the valuation of the previous one. Step 1. December 2025. An internal secondary tender offer established a firm private valuation of approximately $800 billion. No new capital raised, pure liquidity. But it proved the market viewed SpaceX as an infrastructure monopoly, not a contractor. Step 2. February 2, 2026. SpaceX executed a reverse triangular merger with Elon Musk's AI venture, XAI. The all-stock deal assigned a $1 trillion valuation to SpaceX and $250 billion to XAI, launching the combined entity at $1.25 trillion. That merger is the pivot point. SpaceX is no longer an aerospace manufacturer. It is a vertically integrated space-AI conglomerate, pitching markets on a future where AI compute migrates into orbit. Step 3. April 1st. SpaceX filed its confidential draft S-1, setting a syndicate target of $1.75 trillion. Step 4. Mid-April. Lead bankers began floating elevated targets above $2 trillion to sovereign wealth funds, benchmarking against Amazon's current market cap. That is where the headline number comes from. The ceiling, not the floor. The final number will be set during the institutional roadshow the week of June 8th. The 30% retail allocation. If you want more breaking space industry coverage like this, now is the moment. 98% of people watching are not subscribed. Fix that. Subscribe, turn on the bell, and let us continue. In a traditional large-cap IPO, banks allocate 5 to 10% of shares to retail investors. That is how Facebook went public. That is how Saudi Aramco, the current record holder at $1.7 trillion, went public. SpaceX is throwing that model out. Under direct orders from Elon Musk, the offering is structured to allocate 30% directly to retail investors across the US, UK, EU, Australia, Canada, Japan, and South Korea. On a $75 billion raise, 30% is over $22 billion of retail capital. Alone, that would be larger than the entire Saudi Aramco IPO. Chief Financial Officer Brett Johnson, who has served as CFO since 2011, told the 21-bank underwriting syndicate on April 6th. Open quote, "Retail is going to be a critical part of this and a bigger part than any IPO in history. Those are folks that have been incredibly supportive of us and of Elon for a long time, and we want to make sure that we recognize that." End quote. That strategy has consequences, and we will get to those. Starlink is the engine. A $2 trillion valuation represents a roughly 125 times multiple on annual revenue. That math only works if you view SpaceX as a global telecommunications monopoly, not an aerospace manufacturer. The engine that justifies that framing is Starlink. By early 2026, Starlink crossed 10 million active subscribers globally, operating a constellation of over 9,400 satellites. Quilty Space analysts project 16.8 million subscribers by year-end. In 2025, Starlink generated $10 to $12.3 billion, between 61 and 80% of total revenue, at a 63% EBITDA margin. That is a telecommunications utility margin. That is not an aerospace margin. By comparison, the entire launch division, Falcon 9, Falcon Heavy, and Starship generated roughly $5.2 billion at a 33% margin despite controlling 82% of global commercial launches. Launch is the loss leader. Starlink is the cash machine. The Starship dependency risk. Starlink's future growth curve, the curve underwriters are using to justify the valuation, depends entirely on the next-generation Starlink V3 satellites. And Starlink V3 can only be deployed by Starship. Each V3 weighs approximately 1,900 kilograms, more than 3 times the V2 Mini. Each delivers 1 terabit per second of downlink and 160 gigabits per second of uplink, 10 times the downlink and 24 times the uplink of current infrastructure. A Falcon 9 cannot deploy a V3. Starship, designed to lift 100 tons, can deploy up to 60 V3 satellites in a single launch. 60 terabits per second of new network capacity in one flight. If Starship experiences severe developmental delays, if thermal protection issues continue, if the Raptor 3 program hits another major setback, the V3 rollout stalls. And when V3 stalls, the growth curve that justifies a $2 trillion valuation collapses. Institutional analysts have named this the single largest structural risk to the entire IPO. The XAI Profitability Paradox. Here is something that was true 6 months ago and is no longer true. SpaceX was profitable. In 2025, before the merger, the company generated an estimated $8 billion in positive EBITDA on Starlink subscriptions and launch monopolies. Then the merger happened. Internal documents reveal XAI burned through $7.8 billion in just the first 9 months of 2025, roughly $28 million a day on data centers, AI chips, and Grok engineering. Post-merger accounting shows the combined entity is now sitting on a nearly $5 billion net loss for the trailing 12 months. The company pitching a $2 trillion valuation is currently running a $5 billion annual loss. The entire roadshow narrative has to convince institutional investors this loss is the necessary cost of securing dominance in space-based AI computing. The Musk control question. Institutional investors typically demand proportional voting rights when they commit billions in capital. Elon Musk is not offering that deal. The IPO is structured around a dual-class share system. Musk holds approximately 42% of total equity, but controls approximately 79% of voting power through supervoting shares. The public offering will preserve that two-tier structure. Analysts anticipate a hard floor of no less than 25% voting rights for Musk after dilution. Practically, he is expected to retain near 80% dominance over all strategic decisions. Governance analysts have flagged the XAI merger itself as a fiduciary stress test. Musk sat on both sides of that transaction. The $250 billion valuation for XAI was set by boards he appointed, with no independent fairness opinions. Buying this stock, multiple analysts have warned, means surrendering capital to a founder-controlled autocracy. The Alphabet windfall. Some of the biggest winners from this IPO were not even trying to invest in space. In 2015, Alphabet made a $1 billion strategic investment alongside Fidelity. SpaceX was valued at just $10 billion at the time. Recent disclosures filed with the Alaska Commerce Department revealed Alphabet held a 6.11% stake at the end of 2025, diluted to approximately 5% after the XAI merger. At a $2 trillion valuation, Alphabet's stake is worth roughly $100 billion, a 10,000% return on a single venture bet. The rest of the capital stack includes Founders Fund, Sequoia, and Andreessen Horowitz, with NVIDIA and the Qatar Investment Authority joining post-merger. And Elon Musk himself, holding roughly 42% of equity, would see a personal stake worth approximately $840 billion. Combined with Tesla and X, this IPO is structurally designed to make him the world's first verified trillionaire. The competitive shockwaves. The prospect of SpaceX raising $75 billion in fresh capital has triggered genuine panic across the rest of the space industry. Jeff Bezos's Blue Origin is pausing all flights of its New Shepard suborbital rocket for at least 2 years to reallocate engineering toward heavy launch and lunar programs. CEO Dave Limp stated, open quote, "We'll move heaven and earth," end quote, to accelerate those efforts. Blue Origin also unveiled a Super Heavy Class New Glenn 9x4 configuration designed to lift more than 70 metric tons to low Earth orbit, aimed squarely at Starship. Peter Beck's Rocket Lab, trading at a $40 billion market cap, is positioning its medium-lift Neutron rocket, debuting late 2026, as the only cost-effective alternative to Falcon 9. The company recently completed a $155 million acquisition of Mynaric to secure laser optical communications for competing against Starlink. If SpaceX raises $75 billion, it can sustain loss-leading launch pricing indefinitely, starving smaller competitors of the volume they need to survive. The national security stakes. SpaceX is not a normal company. It holds a $3.4 billion Artemis human landing system contract, a $4.9 billion commercial crew contract active through 2030, operates Starshield as a classified military version of Starlink, and holds a classified $1.2 billion national security award. The public S-1 will force SpaceX to navigate a legal minefield, satisfying SEC transparency without violating international traffic in arms regulations or exposing classified Starshield operations. The prospectus is expected to feature heavy redactions with classified annexes submitted privately to the SEC and the Pentagon. The Committee on Foreign Investment in the United States will scrutinize the allocation aggressively. A recent ProPublica investigation, which triggered a Senate inquiry led by Senators Elizabeth Warren and Andy Kim, revealed allegations that Chinese investors had funneled tens of millions of dollars into SpaceX via Caribbean shell entities. With Saudi and Qatari sovereign funds bidding for multi-billion-dollar allocations, the Department of Defense will demand strict oversight to prevent hostile foreign capital from gaining technical insight into dual-use orbital infrastructure. Representatives Adam Smith and Zoe Lofgren have explicitly questioned the "perception of a conflict of interest" in awarding billions in sole-source contracts to a company controlled by the same CEO who co-chairs the Department of Government Efficiency. Congressional scrutiny will be intense, bipartisan, and sustained. The meme stock volatility risk. Now circle back to that 30% retail allocation, because this is where every thread ties together. When a company with this much strategic importance, this much federal contract exposure, this much national security sensitivity, allocates nearly a third of its offering directly to retail investors and explicitly targets Elon Musk's personal fan base as a core subscription pool, the structural risk is enormous. Professor Angel Tengulov and other market analysts have formally warned this allocation threatens to turn the world's most vital aerospace and defense contractor into a meme stock from the moment it begins trading. The price action could become untethered from traditional price-to-sales fundamentals, driven instead by social media momentum and speculative fervor. If retail sentiment shifts violently, critical U.S. defense infrastructure could be exposed to public market volatility in ways the Pentagon has never accepted before.